Australia's $15 billion safety net just evaporated. As of this final trading session of 2025, the Treasury has officially signaled that the floor for thermal coal is dropping to $70 per ton. While the ASX 200 drifts lower in a dull end to the year, the underlying data confirms a strategic mistake. We relied on a China recovery that has been replaced by structural demand destruction. Who pays the price? The Australian retiree and the 65-plus demographic whose pensions and SMSFs are tied to a resource sector that is now 2.3% smaller than it was in January. I am releasing the 2026 resource bankruptcy map today because waiting for a recovery is no longer a viable strategy. Subscribe now and look at the link in the related video to see which mines are becoming zombies before the February RBA shock hits. The commodity shield is gone. To understand why today's $70 coal forecast is a fracture point, we have to look back at 2008 and 2011. Australia survived those global downturns because our commodity shield was impenetrable. We had a single, hungry buyer. But today, December 31st, 2025, that shield has shattered. China has prioritized pipeline gas and domestic production over Australian LNG and coal. We are entering 2026 without the one thing that has saved the Australian economy for 30 years. This isn't just a market dip, it's a structural realignment of the Pacific Basin. The $15 billion hole. Let's look at the Treasury's MyEFO report released this month. The deficit for 2025/26 is forecast at $36.8 billion. They tried to tell you this was an improvement, but they are hiding the inflation revision. Treasury now expects inflation to hit 3.75% by June 2026. This is why RBA Governor Michelle Bullock held the cash rate at 3.60% in the December 9th meeting, and why the shadow board is already whispering about a rate hike on February 3rd if the Q4 CPI prints high. You are being squeezed between a collapsing export price and a rising cost of living. Hunter Valley and Queensland. At $70 per ton, 40% of Australian thermal coal production is underwater. I am naming the zombies. These are the mid-tier producers in the Hunter Valley and the Bowen Basin, who are technically insolvent, but staying alive on credit lines that expire in Q1 2026. If you hold shares in companies like name-specific mid-tiers from your research, or have property in mining-dependent suburbs, you are holding the bag for a market underreaction. The AUD/USD cross. The Australian dollar is buying 66.98 US cents today. It's slipping. Why? Because the lucky country narrative is losing its teeth. When our coal and iron ore, forecasted to hit $60, drop, the global demand for AUD drops. This means everything you buy, from fuel to medication, gets more expensive. This is the double-sided trap of 2026. High retention line. A budget surplus built on a commodity bubble is just a debt in a tuxedo. Don't be fooled by the holiday dullness of today's market. Use this New Year's Eve to audit your SMSF. If you are overweight in ASX miners, you are exposed. Tomorrow is New Year's Day. The markets are closed, but the fracture is still growing. Watch for my full PDF release of the bankruptcy map on Friday. Subscribe and hit the bell so you don't miss the link.